The Wall Street Journal. First article from journal Oil Traders, Ship Tycoons Cash In on Venezuela. Within hours of Nicolás Maduro's capture, executives at commodity merchants Vitol and Trafigura were on the phone to ship owners in Athens. Not days, not weeks, hours. The question was simple. Could tankers from Greece's merchant fleet sail to Venezuela to load oil if Trump relaxed sanctions? The answer came back just as fast. We're on it. This is not a story about Venezuela's oil. This is a story about what happens when a geopolitical event creates an opportunity, and you have both the relationships and the willingness to move instantly. The Wall Street Journal covered this, and it reveals everything about capital allocation, incentive structures, and why some companies profit enormously from chaos, while others sit on the sidelines paralyzed by caution. Let me explain what happened and why it matters. You remember the Venezuela story we discussed before. Oilfield services companies like Halliburton were racing back in. Major producers like Exxon were saying no thanks. But there was a third layer of the story that didn't get full attention: the traders and the tanker owners. They were the fastest movers of all. Think about the incentive structure. Exxon needs to commit billions. It needs to own infrastructure. It needs long-term political certainty. If its assets get seized again, that's a catastrophic capital loss. So it demands guarantees. Halliburton provides services. Its capital is deployed, but smaller and more mobile. It can extract equipment faster if things go sideways. So it's willing to take more risk. We analyzed that. But the traders and ship owners, their capital at risk is almost nothing. Their role is pure optionality. They're arranging, intermediating, moving. They don't own the oil. They don't build anything permanent. They exist to extract rent from chaos. And the moment Maduro fell, they understood the opportunity better than anyone. Vitol is based in London. Trafigura is in Geneva. These are two of the biggest commodity merchants in the world. They exist in the shadows of Western finance, not household names, but absolutely critical operators in global commodity markets. Within hours of Maduro's arrest, they were calling ship owners in Athens asking if tankers could sail to Venezuela once sanctions relaxed. They weren't waiting for Trump to make a formal announcement. They weren't waiting for lawyers to weigh in. They were asking whether it was theoretically possible because they already understood that if it was, they'd be the ones best positioned to execute it. And they were right. Vitol and Trafigura quickly secured licenses from Washington, while competitors were still barred by sanctions. That's the key move. They had the political relationships. They understood how to move fast in geopolitical maneuvering. They weren't outsiders. They had been working with the U.S. government on energy markets and critical mineral supply chains. Let me be clear about what happened next. The U.S. government handed Venezuela 50 million barrels of crude to Vitol and Trafigura to sell. That's not a private transaction. The government didn't extract the oil itself. It gave the oil to traders, and the traders would sell it and handle the proceeds. Initial batches were valued at $250 million each. Think about the logistics involved. Venezuelan ports are in terrible condition. Infrastructure is crumbling. But Trafigura had already arranged to pick up crude from tankers storing it off Venezuela's coast, a risky maneuver that required both expertise and nerve. Trafigura's first cargo arrived in Curaçao last week. It's now being transshipped onto another vessel headed to a final buyer. The barrels themselves are worth somewhere between $2.4 and $2.8 billion, according to Argus Media, but the traders aren't selling them at the prices China paid. Energy Secretary Chris Wright said the U.S. secured prices 30% higher than what Venezuelan oil sold for before Maduro's capture. So the traders are buying from the government at a price and selling to refiners and importers at a higher price. The spread, the margin between what they pay and what they receive, is their profit. Now let me move to the tanker owners. This is where the second wave of capital allocation thinking happens. Freight rates for the largest tankers surged 90% since Maduro's arrest. That's across the entire market, not just Venezuela. Every tanker owner is benefiting from the anticipation that more oil will need to be transported. But the tanker owners heading to Venezuela are charging an additional premium on top of that. Charter prices for mid-sized tankers, ideal for shuttling oil to American ports, leapt. Frontline, Tsakos Energy Navigation and TK are among the public tanker operators seeing their stock prices soar. But the real players are the privately held families. Then Amaris, run by the Martinos family. Okeanis, run by the Alafozos family. TMS Tankers, owned by George Economou. These are Greek shipping families who have spent decades building relationships in commodity markets. They know how to navigate regulatory complexity. They have the right connections, and they understood instantly that a Venezuela reopening meant massive transshipment needs. Look at what's on screen. This is the stock performance for publicly traded tanker companies over the past 6 months. See the baseline? August through November, relatively flat. Even modest gains as the broader market moved. Then December hits. The lines start climbing. Then, January. After Maduro's arrest, the climb accelerates sharply. Frontline, Sacos, TK, all of them up 20, 30, 40% in recent weeks. But here's what the public companies don't tell you. The private tanker owners chartering ships to Vital and Trafigura are negotiating individual deals, securing premiums on top of the already elevated freight rates. One trader told the Journal that the tanker owners and traders would likely earn a tidy profit to compensate for the risks. Let me do the capital allocation autopsy. What did the traders expect when Maduro fell? Their thesis was straightforward. Venezuela's oil market was effectively closed under sanctions. The new government wants to reopen it. If Trump signals openness to Venezuelan oil, the logistics bottleneck becomes the constraint. Someone has to arrange tankers, secure licenses, navigate geopolitical complexity, coordinate with buyers globally. We have relationships with the U.S. government. We understand commodity markets. We can move instantly without needing board approval or shareholder consent. We can secure licenses while competitors are locked out by existing sanctions. Therefore, we will be the intermediaries. And as intermediaries in a reopened market, we will extract enormous value from the spread between government prices and end buyer prices. What actually happened? Exactly that. Vital and Trafigura secured licenses within days. Trafigura's first cargo is already moving. They're lined up as the exclusive traders handling the 50 million barrels the government is selling. The opportunity cost is zero. These companies have flexible capital and global teams. Taking on Venezuela required no capital reallocation from existing business. It was pure optionality. The hidden trade-off? These companies have checkered pasts. Both have tangled with the Justice Department over bribery allegations in Latin America. Vital had corruption issues. Trafigura faced similar challenges. But they've positioned themselves as reliable partners for the American government in energy markets and critical mineral supply chains. That's the calculation. Their willingness to work in markets other Western companies won't touch, combined with government blessing, becomes a license to extract rent from geopolitical transitions. The tanker owners face different trade-offs. They're chartering ships to Vital and Trafigura. They don't own the oil. They don't handle the political risk directly. Their ship gets loaded in Venezuela, sails to the buyer, gets paid. The government covers the legal complexity. But Venezuela's ports are in terrible condition. The infrastructure is crumbling. There's a real risk of delays, mechanical failures, being caught up in sanctions complications despite government assurances. The shipping families are taking genuine operational risk. That's why they're charging premiums. They're not taking the political risk that Exxon is afraid of, but they're taking logistics risk in a degraded environment, and they're pricing that accordingly. Now, let me extract 3 timeless lessons from this moment. First lesson: in geopolitical transitions, the profit goes not to the cautious, but to those who understand intermediation. Exxon sits out because it would need to commit permanent capital. Halliburton goes in because it's providing services. But Vital and Trafigura capture the largest upside because they understand they don't need to own anything. They just need to be the middleman. And in transitional moments, the middleman extracts disproportionate value because information asymmetries and logistics bottlenecks are at their highest. Second lesson: speed and relationships are force multipliers. Vital and Trafigura made phone calls within hours. They had existing relationships with the U.S. government. They could secure licenses while competitors were still reading news articles. In geopolitical moments, the first mover advantage is enormous. The company that can execute fastest, because it has the right relationships and decision-making culture, captures the early spreads. Later movers will compete on thin margins. Third lesson: willingness to operate in disreputable markets becomes an asset when legitimacy is restored. Vital and Trafigura have corruption histories. In normal times, this is a liability. But in a moment when the Trump administration is specifically looking for companies comfortable working in messy, complex Latin American energy politics, Their experience becomes exactly what's needed. The companies that work in markets others won't touch build optionality. That optionality has zero value, until suddenly it has enormous value. Now, here's what I'm convinced of. The traders and tanker owners will make extraordinary profits from Venezuela's reopening. Not because they're smart, not because they took some brilliant strategic risk, but because they understood the specific incentive structure at the exact right moment. Exxon faced shareholder capital at risk and political uncertainty. That's a different equation. Halliburton faced smaller capital commitments and service-based revenue. That's a different equation. Vital and Trafigura faced optionality, relationships, and the ability to extract margin from intermediation. That's the equation that wins when a market reopens. The tanker owners face flotilla costs and operational risk in a degraded environment. They're pricing that risk into their charter rates. And the market is paying those rates because shipping capacity is the genuine bottleneck. This is how capital allocation works in geopolitical transitions. The profit goes not to the boldest, but to those whose incentive structures align with the specific opportunity. Maduro's fall created an opening, but the opening doesn't create profits automatically. It creates profits for companies with the right business model, the right relationships, and the right decision-making speed. The one sentence to remember is this: in geopolitical transitions, the fastest profits go not to producers committing billions, but to traders who understand they don't need to own anything. Just arrange everything. Moving to next title, AI-equipped warehouse sorts real luxury bags from fakes. There's a gap widening in corporate America right now. Not a small one, not something you can rationalize away with adoption curves or early days. It's a chasm, and what makes this chasm dangerous is not the gap itself, it's that nobody at the top seems willing to look directly at it. Here's the situation. Executives are spending vast amounts on artificial intelligence. I mean genuinely massive capital allocation. They're betting the company, in some cases, that AI will usher in a new era of efficiency, better sales, faster back-office functions, productivity gains that compound over years, profit growth that follows inevitably. That's the faith. That's what's being sold to shareholders. But there's a problem. The people actually using the AI tools 8 hours a day? They have a different story entirely. 2/3 of non-management workers, 2/3 say they're saving less than 2 hours a week with these tools. Less than 2 hours. Some saved nothing at all. Meanwhile, more than 40% of executives claim AI is saving them more than 8 hours a week. You're looking at a 5- or 6-fold gap between what leadership believes is happening and what's actually happening on the ground. That difference matters. Let me explain why. This comes from a survey by Section, an AI consulting firm. They talked to 5,000 white-collar workers. This isn't anecdotal. This isn't one person complaining on Twitter. This is signal. This is what happens when you aggregate actual behavior across a large cohort of users. And the pattern is unmistakable. Executives are automatically assuming AI is going to be the savior. Meanwhile, workers are actually trying to use this stuff and discovering that the promise and the reality are two different things. One user experience designer in Raleigh, North Carolina, his name is Steve McGarvey, 53 years old, he's explicit about this. He said he's looked for solutions to problems using large language models and gotten back recommendations that were completely wrong on accessibility questions. His job is making sure visually impaired users can access websites. That's precise work. That's work where being wrong isn't a minor inefficiency, it's a failure. He spent several sessions explaining to an AI bot why a solution it proposed was fundamentally broken. Now, McGarvey isn't against AI. He uses Perplexity as a research assistant and finds it genuinely useful, but he understands something that executives seem to be missing. AI isn't a universal productivity lever. It's a tool that works in some narrow domains and fails spectacularly in others. And if you're building your capital allocation strategy on the assumption that it's universal, you're making a category error. You're betting on the tool instead of understanding the work. This matters because capital allocation is where success and failure are actually decided. Companies are spending billions on AI infrastructure. They're hiring armies of people to implement it. They're rewriting processes around it. All of that is opportunity cost. Every dollar spent on an AI system that saves workers nothing is a dollar not spent on something that might actually move the needle. Let's think about the incentive structure here. An executive hires a consultant, or buys an AI platform and gets a 2-week implementation. In those 2 weeks, they use it intensely. The tool might actually work better for executives. They're using it for high-level synthesis, strategic thinking, rough drafts of communications. Those are exactly the places where AI excels. Then they measure their own productivity, and they're genuinely impressed. 8 hours saved per week. That feels real to them. So they tell the board the AI is working. They justify the spend. They feel vindicated. Meanwhile, the people down the line, the people whose jobs actually depend on execution precision, are trying to use the same tool for work that requires accuracy, judgment, context. And they're discovering that the tool hallucinates. It produces plausible-sounding nonsense. It confidently suggests answers that are subtly, dangerously wrong. So they can't trust it. They have to verify everything it does, which means they're spending more time, not less time, because they have to do the original work and then the verification work on top of it. The incentive is misaligned. The executives who bought the tool benefit from it. The people who have to live with its limitations bear the cost. And nobody's measuring the actual outcome, the delta between expected and actual productivity, at the level where it matters. What's happening here is something we see again and again in business history. Success in one domain gets extrapolated into a domain where it doesn't apply. Someone finds a productivity tool that works, and they assume it works everywhere. They scale it before they've really understood the constraints. And by the time the data arrives, by the time reality corrects the assumption, they've already allocated the capital, signed the contracts, and committed to the narrative. I keep coming back to one line in this reporting. Executives automatically assume AI is going to be the savior. Not hope. Not estimate. Assume. That word tells you everything about the incentive structure. They've decided in advance that this will work. They're not testing it. They're not asking hard questions about where it actually creates value and where it doesn't. They're just assuming. And that's a compounding problem because while they're assuming, they're making decisions. They're setting budgets. They're communicating to the board. They're telling investors the company is ahead of the curve on AI adoption. They're even using it as justification for strategic decisions. All of that locks in the original assumption before the evidence has time to accumulate. The visible evidence here, the actual data in the survey, is stark. 2/3 of workers, nothing. 40% of executives claiming 8+ hours saved. That's not a small discrepancy. That's not a measurement error. That's a signal that something fundamental is wrong with either the selection of tools, the training on those tools, or the expectation setting around what those tools can do. Think about what this means for capital allocation over the next 3 to 5 years. These companies have made massive commitments to AI infrastructure. That infrastructure is now locked in. The people who approved it are invested in its success. The narrative has been sold. So what happens when the productivity gains don't materialize? When workers continue to say they're not saving meaningful time? Typically, there are a few paths. 1. Executives convince themselves the tool is still working and blame workers for not adopting properly. They create training programs. They issue mandates. They try to force adoption because admitting the tool doesn't work would mean admitting the capital allocation was wrong. That delays the reckoning, but makes it worse when it comes. 2. They quietly reduce AI spending without admitting it publicly, absorbing the loss, and moving on to the next thing. That happens, but not before wasting years and dollars. 3. Someone actually does the analysis, traces where AI creates value and where it doesn't, and makes precise capital allocation decisions. That's rare. That requires intellectual humility. That requires someone being willing to admit they were wrong. Now, here's where this connects to something larger. This isn't just about AI. This is about how success plants the seeds of failure. Companies that have dominated digital have become comfortable assuming that digital solutions work everywhere. Amazon has spent years trying to translate online dominance into brick-and-mortar success. They've tried Amazon Go. They've tried branded stores. They've closed most of them. Now they're planning a 230,000 square foot megastore in the Chicago suburbs, so large it could nearly fit 2 Target stores. They're finally going big box. The assumption was that digital expertise would translate into physical retail. It didn't. So now they're trying to do what Walmart and Costco have done for decades. They're 20 years behind the learning curve, but they're committing massive capital to catch up. That's what happens when you assume your competency in one domain applies everywhere. The AI story is the same pattern, compressed into months instead of years. Companies that succeeded with digital transformation are assuming they'll succeed with AI transformation the same way. But the actual work, the actual bottleneck, isn't digital or analog. It's precision, it's judgment, it's context. And AI, right now, is mediocre at all three. Here's what I think is really important to understand. The incentive structure makes it almost impossible for executives to see this clearly. If you're the CTO of a major company, and you've just convinced your board to spend $100 million on AI infrastructure, and then the data comes back showing that workers are saving almost nothing, you have a choice. You can look at that data straight on and say, we allocated this capital wrong. Or you can find reasons to doubt the survey. You can point to the companies that are supposedly getting productivity gains. You can argue that it's too early to measure. You can blame workers for not adopting properly. Guess which path most people choose. That's not cynicism. That's incentive structure. The person who approved the spending has reputation and capital on the line. The cost of admitting error is enormous. The cost of the error itself is diffuse. It's spread across the company, across time, absorbed into operating expense ratios. So the incentive is to perpetuate the narrative, not to correct it, which means the gap between what executives believe and what's actually happening is probably going to widen before it narrows. The data will get worse. More companies will report that productivity gains haven't materialized. More workers will say they're not saving meaningful time. And executives will double down on implementation, training, and optimization, hoping that more of the same will finally make it work. It never does. Not when the fundamental assumption is wrong. Let me extract the 3 durable lessons from this situation, because there's something here that applies beyond AI. This is about how you allocate capital when you don't actually know what's going to work. First lesson: incentives shape perception. The person making the decision is not the person living with the consequence, so they see different evidence. They interpret the same data differently, and they have every reason to believe what confirms their decision and doubt what contradicts it. That's not malice. That's how human beings work, but it's deadly in capital allocation. If the person spending the money can't see the actual impact clearly, they'll keep spending it even when it's not working. The solution isn't to blame the executive, it's to structure the measurement so that the incentives align. Make executives accountable for the actual productivity change, not just adoption metrics. Make them feel the cost of being wrong. Then watch how quickly the analysis becomes precise. Second lesson: scale reveals what talent conceals. A small group of really smart people might find genuine use cases for an AI tool. They might save significant time. That sample is then generalized into AI saves 8 hours a week. But the middle and bottom of the distribution might get almost nothing. The tool might actually make them slower because it produces confident nonsense they have to verify. This is why pilots lie. They show you the best case. They don't show you the average case. And they definitely don't show you the worst case, the person for whom this tool is actively destructive. When you scale from pilot to company-wide, you move from the best case to the average case. The productivity gains evaporate. Third lesson: betting on the platform is different from betting on the work. The executives in this story are betting on AI as if AI is the thing that creates value. But AI doesn't create value. Work creates value. Specific work in specific contexts where the tool solves a bottleneck. If your bottleneck is, we need to think faster, AI might help. If your bottleneck is, we need to be more accurate, AI probably hurts. You have to understand your actual constraint. You have to measure the tool against that specific constraint. You can't just bet on the platform. You have to bet on the work. And you have to be willing to measure whether the platform is actually helping with the work. Because here's what happens if you don't. You spend years, billions of dollars, and enormous organizational energy on something that isn't actually moving the needle. You convince yourself it's working because the executives using it found it useful. You blame workers for not adopting properly. You implement more training, more mandates, more infrastructure. And meanwhile, the actual productivity problem, the thing that would actually compound value, goes unsolved. All of that capital, all of that attention, all of that organizational focus gets wasted. It gets compounded wrong. And the people making the decisions, get to leave before the market finally figures out that the emperor has no clothes. This is why the gap between executive and worker experience matters so much, because that gap is usually where the truth lives. It's where you can actually see whether the capital allocation is working. If you're spending billions on something and the people doing the work say it's not helping, you should probably believe them. Not because executives are stupid, not because workers are always right, but because the incentive structure makes it very unlikely that executives will see this clearly, and the workers have fewer reasons to lie. The survey data is stark. 2/3 of workers saving less than 2 hours a week, some saving nothing, against 40% of executives saving more than 8 hours a week. That's not a measurement error, that's a signal. That's the market trying to tell you something. And most companies are probably going to ignore it. They're going to keep spending. They're going to keep implementing. They're going to keep believing. And eventually, probably not soon, but eventually, the market will make it clear that the productivity gains didn't materialize, and someone else will inherit the problem. That's the pattern. That's how capital gets misallocated. That's how success in one domain, digital transformation, online retail, creates the blind spot that makes you miss the fact that your AI bet isn't working. You assume the competency transfers. You assume your intelligence and resources can solve this too. You assume the tool is the thing. But the tool is never the thing. The work is the thing. The constraint is the thing. The ability to measure what's actually happening is the thing. And right now, most executives have none of those. They have a tool, they have an assumption, and they have a survey that contradicts both. And the incentive structure makes it almost certain they're going to ignore the survey and keep believing the assumption. Here's the thing I'll leave you with. The companies that are going to win in the AI era won't be the ones that spend the most money on AI. They'll be the ones that spend the most time understanding where AI actually solves their specific problem. They'll be the ones ruthless enough to admit when it doesn't. They'll be the ones willing to measure carefully at the level where the work actually happens. And they'll be the ones willing to kill the initiative when the data says kill it. That's harder than just betting on the platform. That requires honesty. That requires intellectual humility. That requires being willing to look at the gap between what you believe and what's actually happening and genuinely care about closing it. Most companies aren't built for that. Most executives aren't incentivized for that. So they'll keep spending money on AI productivity while their workers keep saying it's not working. And the gap will widen, and the capital allocation will worsen. And 5 years from now, people will write case studies about how this company bet the farm on AI and nothing compounded the way they thought it would. Because that's what happens when incentives misalign, when the person making the decision doesn't have to live with the consequences. When you assume the work doesn't matter, only the tool does, that's when the best companies make their worst calls. Watch where the gap is widest. That's where the truth is hiding. Rolling to next title, beer brand Dos Equis brings back most interesting man in the world. Dos Equis is bringing back the most interesting man in the world. After 10 years. Let that sit for a moment. Not because the character was just okay. Not because the brand felt neutral about him. But because they killed him. They sent him to Mars. They replaced him with a younger actor. They stopped using the catchphrases. They tried to move on. And now, at 87 years old, Jonathan Goldsmith is coming back. More billboards, more TV, more social media, more events, more appearances at distributor meetings. They're going to make him live so much more virally online, according to Maggie Timoney, the CEO of Heineken USA. This is not a triumph. This is a capitulation. And it tells you everything about what happens when success plants the seeds of failure. And nobody has the courage to admit it while the seed is still small. Here's the basic story. From 2006 to 2016, Dos Equis had something magical. Jonathan Goldsmith became an original internet meme. The catchphrase, "I don't always drink beer, but when I do, I prefer Dos Equis," became part of the culture. During his tenure as the face of the brand, Dos Equis sales nearly tripled. Tripled. That's not gradual growth. That's a founder who figured out the product, the positioning, the message. That's working. And then, in 2016, they made a decision. They decided to replace him. They decided the character was getting old. They decided they needed to appeal to younger consumers. So they sent the most interesting man on a one-way journey to Mars and handed the title to a younger actor. They even stopped using the catchphrases. They tried to be fresh. They tried to be contemporary. What happened next is predictable. Dos Equis has been declining ever since. Let me walk through the numbers, because numbers don't lie. They tell you what actually happened, stripped of all the narrative and hope and intention. Dos Equis's share of the imported beer category in the U.S. declined from a peak of 6.1% in 2014 to 3.6% in 2000. That's a decline of nearly 40% of market share in a single decade, over 10 years. It's slow enough that executives can rationalize it. It's fast enough that the business is systematically being destroyed. Then, look at 2025 specifically. Dos Equis U.S. retail store sales in dollar terms fell about 8% in 2025. Compare that to their main competitors, Modelo and Corona. Both of those brands saw declines of only 2%. So Dos Equis is declining 4 times faster than the companies it's supposed to compete with. And now look at the absolute scale of the business. Dos Equis represents just under 1% of beer sold in U.S. stores by dollars. 1%. That's tiny. That's a brand that has already lost the battle for relevance. The company now says they hope to triple that share over the next decade. Triple it. Think about that for a moment. They're down to 1%. They're bringing back an 87-year-old man to try to triple the share. This isn't strategy. This is desperation dressed up as nostalgia. What makes this case so interesting to me is that it's a clean example of something that happens again and again in business. Success in one domain creates the arrogance that you can succeed everywhere else. Executives looked at the data in 2016. The Most Interesting Man campaign was wildly successful. It was driving sales. It was generating cultural conversation. It was an original internet meme. Memes are the currency of the modern internet. They're how ideas spread. They're how brands get free reach. Dos Equis had one. So what did they do? They killed it. Because they looked at the data and saw one thing. The character is getting old. Consumers want young. So they inverted the entire successful formula and expected a different outcome. This is what I call success killing success. The thing that worked was the character and the consistency of the message. The thing that worked was showing up, year after year, with the same voice, the same perspective, the same catchphrase. That consistency creates trust. It creates recognition. It creates the kind of cultural resonance that can't be rushed or manufactured. But executives saw the success and thought the mechanism was something else. They thought it was freshness. They thought it was youth appeal. They thought it was novelty. So they destroyed what was actually working and tried to rebuild around what they thought should be working. By the time they realized the mistake, the moment had passed. Now let's think about the decision-making structure. In 2016, someone at Dos Equis, probably at the executive level, probably in marketing, made the decision to retire the character. What information did they have access to? Presumably good market research. Presumably data about consumer preferences for younger spokespeople. Presumably some argument that the character was aging out of relevance. What information did they not have access to? They didn't have access to what actually mattered, the cultural resonance of consistency. They didn't know what they didn't know about why the campaign worked. They knew it was driving sales. They didn't know that the magic was in the reliability of the message and the commitment to a single voice. So what did they do? They killed it. Because they looked at the data and saw one thing. The character is getting old. Consumers want young. So they inverted the entire successful formula and expected a different outcome. This is what I call success killing success. The thing that worked was the character and the consistency of the message. The thing that worked was showing up year after year with the same voice, the same perspective, the same catchphrase. That consistency creates trust. It creates recognition. It creates the kind of cultural resonance that can't be rushed or manufactured. But executives saw the success and thought the mechanism was something else. They thought it was freshness. They thought it was youth appeal. They thought it was novelty. So they destroyed what was actually working and tried to rebuild around what they thought should be working. By the time they realized the mistake, the moment had passed. Now let's think about the decision-making structure. In 2016, someone at Dos Equis, probably at the executive level, probably in marketing, made the decision to retire the character. What information did they have access to? Presumably good market research. Presumably data about consumer preferences for younger spokespeople. Presumably some argument that the character was aging out of relevance. What information did they not have access to? They didn't have access to what actually mattered, the cultural resonance of consistency. They didn't know what they didn't know about why the campaign worked. They knew it was driving sales. They didn't know that the magic was in the reliability of the message and the commitment to a single voice. So they made the decision anyway. And who paid the cost? Not the executives who made the decision. They had moved on to other roles, other companies, other opportunities. The cost was paid by the distributors who watched the brand's relevance decline. The cost was paid by the salespeople who had to explain why they weren't hitting volume targets. The cost was paid by the shareholders who watched market share evaporate. This is the hidden cost structure of large organizations. The person making the strategic decision doesn't live with the consequence, so they can afford to be wrong. They make the bet. It fails. And someone else inherits the problem. By the time the problem is undeniable, the original decision maker is long gone. Now look at what's happening in 2025 and 2026. Dos Equis is in crisis. The brand is getting crushed by Modelo and Corona. The category is under structural pressure. There's health and Ozempic-driven aversion to carbohydrates. There's changing consumer tastes. There's concern over rising prices. The entire beer industry is declining. Heineken's beer volume in the Americas region declined 7.4% organically in the company's latest quarter. That's the industry headwind. And into that declining category, Dos Equis is losing share faster than anyone else. So what does management do? They go back and get the original guy. They're going to make him more viral. They're going to have him do more appearances at distributor meetings. They're going to make him live on social media more than he did in 2006. This is what desperation looks like. This is what happens when you've killed your brand and you're trying to resurrect it. And it probably won't work. Not because the most interesting man is a bad character. He's not. But because you can't go backward and expect to move forward. The cultural moment has changed. The media landscape has changed. The competitive position has changed. You can't just rewind the clock and expect the same magic to work again. The best case scenario for Dos Equis is that they slow their decline. Maybe the nostalgia play gets some press coverage. Maybe some older consumers remember the good times and come back. Maybe they get a temporary lift, but the structural problems don't go away. The brand doesn't become 1% again. The market doesn't suddenly decide that Dos Equis is more relevant than Modelo or Corona. Now let me extract what this case teaches us, because there are 3 lessons here that apply far beyond beer. First lesson: success creates blindness to the mechanism of success. Dos Equis looked at their data and saw declining sales for the character, and they thought the mechanism was age. But the mechanism wasn't age. The mechanism was consistency and cultural resonance. An 87-year-old man in 2006 was exotic and interesting and different. An 87-year-old man in 2016 was just old, so they killed him. But what they actually killed was the consistency. What they actually killed was the permission to own one voice and stick with it for a decade. They replaced it with novelty. And novelty doesn't compound. Novelty fades. Consistency compounds. Second lesson: the person making the decision is not the person living with the consequence. When the most interesting man was retired, someone in marketing felt like they had made a strategic move. They felt like they had modernized the brand. They felt like they had made a bold call, but the consequence of that call was borne by everyone downstream: the salespeople, the distributors, the shareholders. The person who made the decision probably got promoted. The person who lived with the consequence got fired. This is how incentive structures within organizations systematically push people towards short-term moves that create long-term damage. Third lesson: when you try to resurrect something you've killed, you're playing a desperation game. Dos Equis can bring Jonathan Goldsmith back. They can put him on billboards. They can make him go viral. But the brand lost 10 years of cultural relevance. They lost market share to competitors who kept moving forward while Dos Equis was floundering. They built Modelo and Corona's reputation in the minds of American consumers. Now they're trying to win back something they threw away. The deck is stacked against them. The reason I'm spending time on Dos Equis is because this is a case study in how the best companies make their worst decisions. Equis had something great. They had a founder figure, in this case a character, but the principle is the same. They had a clear positioning. They had cultural resonance. They had compounding returns from consistency. And then they got bored. They thought the magic was somewhere else. So they broke the thing and tried to build it again from scratch. It's the same thing that happened with Amazon's retail strategy. It's the same thing that happened with companies pivoting away from their core business because they got distracted by what seemed like bigger opportunities. The best companies are the ones that look at what's working and ask hard questions before they change it. The worst companies are the ones that change it the moment it stops feeling novel. Here's what I'll leave you with. Maggie Timoney says they want to triple Dos Equis's market share over the next decade. They're bringing back an 87-year-old man to do it. If that works, it will be a miracle. But more likely, it's going to be a slow decline. Because you can't go backward and expect to move forward. You can't kill what's working and then resurrect it and expect it to work the same way. The cultural moment passes. The competition moves ahead. And what you're left with is nostalgia instead of relevance. The hardest lesson in business is knowing when not to change what's working. Dos Equis had that. And they threw it away. Now they're hoping nostalgia can do what strategy couldn't. It probably can't. Moving to the next title. Trading activity lifts Schwab. Retail investors poured a record amount of money into stocks and exchange-traded funds in 2025, topping the levels seen during the meme stock frenzy of 2021. Let that sink in. We're talking about a bigger wave than the meme stock mania, bigger than the pandemic retail trading boom. More capital flowing from individuals into financial markets than we've ever seen. And the person positioned to capture that capital flow, the gatekeeper for all of it, is Charles Schwab. Their earnings just came in. And the numbers tell a story about what happens when you're in the right place at exactly the right time. But also, what happens when you have to make strategic decisions about what business you will and won't do. Here's the situation. Schwab reported a 34% increase in quarterly profit. Not revenue. Profit. Net income rose to $2.46 billion. That's a gatekeeper business in an environment where the gates are swinging wide open. Trading revenue rose 22% to just over $1.07 billion. Net interest revenue climbed 25% to $3.17 billion. Total revenue rose 19% to $6.34 billion. These are not the numbers of a company that's managing decline. These are not the numbers of a business that's dealing with structural headwinds. This is a company experiencing a tailwind so powerful that they're printing money in real time. And the tailwind is simple. Individual investors are coming back to the market. Not slowly, not in measured waves, in a tidal wave. But here's what makes this moment interesting to me. It's not just that the tide is rising. It's that Rick Wurster, the CEO of Charles Schwab, has to decide which doors to open and which doors to keep closed. Because with this kind of capital flowing, and with individual investors hungry for access to new markets, the temptation to monetize everything is enormous. And Wurster has to decide which opportunities to pursue and which to pass on. Let me explain the situation. Retail investors have been empowered by back-to-back years of strong returns and by expanded access to new asset classes and product types. In November, Schwab announced its acquisition of Forge Global, a marketplace that will allow customers to buy shares in private companies. That's significant. They're opening access to something that used to be reserved for institutions and the ultra-wealthy. They've also pledged to allow spot trading for Bitcoin and Ether in the first half of this year. Cryptocurrency. They're saying yes to that. But Wurster has drawn the line at prediction markets. Prediction markets have exploded in popularity. They allow users to bet on the outcome of future events, including sports. And Wurster has said Schwab would steer clear of those contracts. Though he hasn't ruled out offering prediction markets that are tied more directly to financial markets and the economy. This is a perfect example of strategic capital allocation at the enterprise level. Wurster is not a maximizer. He's not trying to capture every possible revenue stream. He's making choices about what kind of business Schwab is and isn't. And that's revealing, because most companies in his position would do the opposite. They'd look at the money pouring in and say yes to everything. They'd open every door and monetize every opportunity. But Wurster sees prediction markets tied to sports as a line he doesn't want to cross. Why? I think it's because he understands something fundamental about long-term brand positioning. Schwab is a broker. It's an intermediary. It's a trust business. And the moment you start offering contracts that are essentially gambling on sports outcomes, you've moved into a completely different category in the eyes of regulators and in the eyes of your customer base. You've moved into a business where your product is the bet itself, not the access to the market. That's a foundational shift, and Wurster is saying no. He's saying the incremental revenue isn't worth the franchise risk. That's rare. That's the kind of capital allocation discipline you see in exceptional operators. Now let's talk about what's actually happening with the customer base. Worster said that the average Schwab client is in their 40s, but nearly one-third of the company's new customers last year were Gen Z adults under 29. Think about that ratio. One-third of new customers are under 29 years old. That's not a tale, that's a primary narrative. That's the demographic composition of the future. He said, and I want to emphasize this, we're winning with every demographic and every type of investor. Not we're growing with, not we're reaching, winning. That word choice matters. That suggests they're not just participating in a boom, they're dominating it. Let me walk through the numbers because they're important and they paint a picture of exactly where capital is flowing in the financial ecosystem. On the screen right now, you're seeing Charles Schwab's quarterly net profit over the past year. On the left side, you've got 2024. On the right, you've got 2025. It's a line chart. The numbers go from 0 to $2.5 billion on the vertical axis. And what you see is a line that starts around $1.84 billion at the end of 2024 and ends at $2.46 billion at the end of 2025. That's not a gradual climb. That's a step function. There's a visible jump in the trajectory. That single chart tells you everything. The fourth quarter was the strongest. The profit during the quarter hit $2.46 billion. That's the peak of the line. That's when the retail wave was at its highest. That's earnings power concentrated in a single quarter. And if you're looking at this, the narrative is clear. The strong year got stronger as it went on. The momentum didn't fade. It accelerated. Now, what's the mechanism? What's actually creating this profit? It's two things: trading activity and net interest revenue, which is the spread between what Schwab pays out to depositors and what it collects from investments and loans. Trading revenue up 22%. That's individuals buying and selling. That's commissions and execution revenue flowing in. Net interest revenue up 25%. That's the spread. That's borrowing short, lending long. That's the basic banking function, compressed into a brokerage context. The fact that net interest revenue grew faster than trading revenue is interesting. It suggests that Schwab isn't just capturing transaction fees. They're capturing the structural economics of being between the borrower and the lender. They have deposits. They have cash. They have trillions of dollars of customer assets flowing through their system, and they get to use some of that as a spread. That's not a commission business. That's an economics business. Now, let's think about the decision-making structure and the capital allocation. Worster is standing at a moment where he could say yes to everything. Prediction markets would add revenue. Sports betting would add to the mix. Leverage would increase profit. But instead, he's saying no to some of it. Why does that matter? Because it tells you something about the difference between maximizing profit in the current year and building a sustainable franchise. Schwab is not trying to maximize current year earnings. They're trying to maximize long-term optionality and brand integrity. They want to be the broker for individuals. They want to be trustworthy. They want to be the default choice for someone who opens their first brokerage account at age 25. That person needs to use Schwab at 65. The company only wins if that relationship compounds over decades. If you add sports betting prediction markets to the product mix, you're creating friction with regulators. You're potentially creating friction with some customers who see that as a step toward gambling. You're changing the brand positioning. That's not a good trade. That's not the kind of move that compounds. Compare that to Forge Global, the private company marketplace. That's aligned with the brand. That's expanding access. That's giving customers what they want in a way that's fundamentally aligned with Schwab's core business. And crypto spot trading, that's where the world is going. Everyone wants access to Bitcoin and Ether. Schwab is saying yes, but not to sports betting. This is what I mean by capital allocation discipline. Worster is not a maximizer. He's a strategist. He's making choices about what kind of business he wants to build. Now let's look at the broader context. Retail investors flooding into financial markets. That's the tailwind. But what does that tailwind look like? Poured a record amount of money into stocks and ETFs in 2005. More than the meme stock frenzy of 2001. More than any other period on record. What's driving it? Back-to-back years of strong returns. That's first. The market went up. People made money. People want to repeat that experience. The second thing is expanded access to new asset classes. Crypto. private companies, options, fractional shares. The market has opened up in the past decade. You can buy a fraction of a Tesla share now. You couldn't do that 10 years ago. That's a distribution decision that's changed the entire retail ecosystem. The third thing is social proof. The meme stock frenzy of 2021 proved to a generation of young people that you could do this. You didn't need a financial advisor. You didn't need permission from an institution. You could open an app and trade. That's a psychological shift. That's not reversible. All of that is flowing into Schwab, and Schwab is capturing it through trading commissions and net interest spreads. Now let's extract the lessons, because there's something important here that applies beyond Schwab. First lesson: tailwinds are seductive. When capital is flowing and growth is accelerating, the temptation to monetize everything is overwhelming. Schwab could do it. They could say yes to prediction markets. They could leverage up. They could cut costs to expand margins. They could do all of it and still grow. But the key insight from Worster is that not all revenue is good revenue. Some revenue comes with franchise risk. Some revenue degrades your long-term positioning. The test isn't whether you can make money from something. The test is whether making money from it makes you stronger or weaker in the eyes of the customer who might stick with you for 30 years. Second lesson: demographics compound. Nearly 1/3 of Schwab's new customers are under 29 years old. That's not just good for this year. That's a bet on 30 years of relationships. That's 1/3 of new customers coming from a demographic that hasn't even hit peak earnings yet. In a compounding business, that's everything. You don't need to win Gen Z. You just need to be their default choice at the moment they open their first account. Then time does the rest. Third lesson: when you're the gatekeeper and the gates are open, the quality of your decisions matters more than the quantity of opportunities. Schwab has capital, they have brand, they have scale. The constraint isn't opportunity. The constraint is judgment. Should we do this? Should we pass on that? Those decisions compound. 20 years from now, the decision to say no to sports betting prediction markets will either look brilliant or irrelevant. But the decision to build relationships with a generation of young investors looks brilliant today and will probably look brilliant in 30 years. Here's what I find fascinating about this moment. The retail investing boom is real. The capital flows are real. Schwab is capturing them. But what makes Schwab different from the companies that will blow up in the next downturn is that Worster is not trying to extract maximum value in the current cycle. He's trying to build a franchise that survives multiple cycles. That's not obvious from the earnings report. The earnings look amazing. Profit up 34%, revenue up 19%. But the story inside those numbers is about discipline. It's about saying no. It's about understanding that in a gatekeeper business, your moat isn't just scale, it's trust. And you protect trust by making unpopular decisions when the opportunity cost is highest. The other thing that matters here is the customer composition. Worster said the average Schwab client is in their 40s, but 30% of new customers are under 29. That's a demographic shift. That's compounding. In 5 years, the average client age gets younger. In 10 years, it's even younger. In 20 years, the average Schwab client is someone who opened their account during the 2025 retail boom when they were 25 years old, and they've been a customer continuously ever since. That's not something you build by maximizing current year earnings. That's something you build by making decisions in the long-term interest of the customer. Sometimes that means saying no to revenue. Sometimes that means saying yes to an acquisition like Forge Global that expands customer options even if the unit economics aren't obvious yet. The tailwind will eventually fade. The retail investor enthusiasm will eventually cool. Valuations will eventually compress. When that happens, Schwab will have a customer base that's younger, more diverse, more engaged with multiple asset classes, and more aligned with where the world is going. That's the bet. That's the strategic move. And that's why the earnings matter less than the decisions embedded in the earnings. Here's what I'll leave you with. Most companies look at a boom like this and ask how much they can extract. Rick Worster looked at a boom like this and asked what kind of business he wanted to build. That question, asked at the right moment with enough discipline to follow through, is the difference between a company that compounds and a company that overextends. Schwab is positioned to compound, not just this year, but across decades. Moving to the next title, NVIDIA CEO urges more investment in AI. Jensen Huang said something remarkable at the World Economic Forum in Davos. He said the AI bubble doesn't exist because the investments aren't irrational. The investments are large because we have to build the infrastructure necessary for all of the AI layers. Then he said something that matters more. Everybody ought to get involved. That's not a casual comment. That's a man who built a company with a market cap in the trillions, saying that we're still in the early innings. We're still at the point where you should be allocating capital. We haven't overshot. We haven't overinvested. We need more. More infrastructure, more chips, more power, more skilled workers. Here's why that matters. Because at this moment, there's real skepticism emerging about whether AI spending is justified. Real, legitimate concern that the big tech companies are spending too much, too fast, and that we're building infrastructure for a world that doesn't exist yet. That's the fear. That's the doubt that's creeping in. And Jensen Huang, the guy who's profiting more than almost anyone else from AI infrastructure spending, is saying no. The investments are not too large. They're exactly the right size. Maybe they're too small. Let me think about what makes that statement worth examining. First, you have to understand what Jensen Huang actually is. He's not just the CEO of NVIDIA. He's the gatekeeper of the infrastructure layer. Every serious company trying to build AI capability has to buy chips from NVIDIA. They have to rent GPU capacity. They have to go through Huang's company. So when Huang says more investment is needed, he has the most obvious conflict of interest. He profits directly from more AI spending. But here's where it gets interesting. He's not lying. He's not exaggerating. He's describing something real. And the proof is in what's happening at companies like The RealReal, the luxury consignment platform. Let me explain the setup. The RealReal receives millions of items a year. Clothing, bags, accessories. All of it is consigned. Sellers send it in. The RealReal lists it. If it sells, the seller gets a cut. The problem is that authenticating millions of items is impossibly expensive and slow. You need people. Experts. People who can tell the difference between a real Louis Vuitton bag and a fake. People who understand materials and construction and the subtle details that separate authentic from counterfeit. The RealReal built an AI system called Athena. That system is trained on millions of images of real and fake items. It assigns a risk score to each item. Low-risk items can be processed automatically. High-risk items still go to human authenticators. But even for high-risk items, Athena is helping. It's running analysis in the background. It's pulling up comparison images. It's validating hypotheses. It's making the human authenticators better. The results are tangible. The RealReal expects Athena to cut the time it takes for an item to go from loading dock to listed for sale from 14 days down to 7 days. 50% faster. They're also saving a couple of dollars on every sale. More importantly, they're building a system that scales. When they take on more volume, they don't need to hire proportionally more authenticators. They need more computational capacity. That's a fundamental shift in the economics of their business. But here's the thing that really matters. This system only exists because someone built the chips. Someone built the training infrastructure. Someone, over the past 5 years, allocated massive capital to building the computational layer that makes Athena possible. That someone is Jensen Huang. That capital is what he's defending, and he's right to defend it. Because without that capital allocation, without that infrastructure build-out, the RealReal doesn't have Athena. Hundreds of companies don't have the systems they're building right now. So let me walk through Huang's framework because it's useful and it reveals something about how he thinks about capital allocation. He describes AI as a 5-layer cake. Energy, chips, cloud infrastructure, models, applications. That's the stack. Energy at the bottom, because you can't run any of this without power. Chips next because you need hardware to do the computation. Cloud infrastructure because you need the platforms to orchestrate the chips and the data and the algorithms. Models next because you need the large language models and the algorithms themselves. And applications at the top because that's where the economic value actually lives. Here's where most people miss the point. Huang says the applications layer is the most critical. That's where the economic benefits lie. That's where the value is generated. So when critics say we're over-investing in chips and infrastructure, they're missing the point. You can't build valuable applications without building the infrastructure underneath. The infrastructure is necessary. It's not optional. But here's the thing that Huang doesn't explicitly say, but that's embedded in his thinking. The applications layer is where the value is. But the applications can't exist without the infrastructure layer. And NVIDIA owns the infrastructure layer. So the bet is that the value will be generated at the applications layer, but it will flow back to the infrastructure layer through demand for chips and cloud capacity and computational power. It's a second-order bet. It's betting that the real's Athena will become so valuable that they'll need more chips, more capacity, more power, more infrastructure, and that demand will flow back to NVIDIA. And that's where the profit is. Huang understands this. He's saying we need more investment in the stack. The investments are large because we have to build all of the layers, not just some of them. All of them. Energy, chips, cloud, models, applications. Build them all. Now, here's the part that matters from a capital allocation perspective. Even renting older generations of GPUs is becoming more expensive. That's a signal. That's demand outpacing supply. That's scarcity. When you have scarcity, you have power. When you have power, you can raise prices. When you can raise prices, profit margins expand. Huang just told you, obliquely, that NVIDIA's pricing power is increasing. That's not a bubble signal. That's a moat signal. That's a signal that the infrastructure is becoming more valuable, not less. He also said something interesting about jobs. More power and skilled workers are needed. He said it's the single largest infrastructure build-out in human history. Electricians, construction workers, network technicians, data center engineers. All of this is job creation. All of this is economic activity. This is not a bubble dynamic. A bubble is overinvestment in something that produces no real value. But this is overinvestment in something that's generating enormous economic value. There's a difference. Let me think about what Huang is really doing when he makes these statements. He's doing two things simultaneously. One, he's defending the narrative that more investment is justified. He's saying the AI bubble doesn't exist because the investments are rational. That's the obvious thing he's doing. That benefits NVIDIA directly. That justifies continued GPU purchases. That keeps the revenue flowing. But the second thing he's doing is more interesting. He's making a bet on the specific character of the AI revolution. He's saying it's not going to be localized to a few industries. It's not going to be an anomaly. It's going to spread. Energy, semiconductors, healthcare, finance, every sector, every vertical. And each of those sectors is going to need chips. They're going to need cloud infrastructure. They're going to need computational power. So the bet is not just that AI is real. The bet is that AI adoption is going to be universal. And when adoption is universal, the infrastructure layer becomes critical. And when the infrastructure layer is critical, whoever controls the infrastructure layer captures disproportionate value. Now let's go back to the real for a moment because it's a perfect example of what Huang is describing. Athena is an application. It's solving a real problem. It's cutting processing time in half. It's saving money on every sale. It's building a scalable system. That's valuable. That's real economic value. But Athena only exists because someone invested in the foundational models. Someone invested in the training data. Someone invested in the computational capacity to train those models. Someone built NVIDIA's chips. Someone built the cloud infrastructure. All of that capital had to be deployed before Athena could be built. And now that Athena exists, it's going to drive more demand for computational capacity. It's going to drive more demand for NVIDIA's chips. That's the mechanism. That's how the value flows from applications back to infrastructure. Huang is saying, essentially, we're still in the phase where the applications are being invented. We don't know yet which applications are going to be valuable, but we know that valuable applications are going to require infrastructure. So the right move is to build out the infrastructure now. Overkill it if necessary. Build more than you think you need, because the applications will catch up, the demand will catch up, and the infrastructure will become the constraint. This is bold. This is the opposite of what most executives do. Most executives build to the current demand. They wait for demand to appear, and then they invest. Huang is saying invest ahead of demand. Build the infrastructure first, then watch the applications catch up. It's a founder's bet. It's a long-term capital allocation decision. It's saying we can afford to be wrong about the timing because the structural shift is inevitable. AI is going to be everywhere. When it is, everyone will need infrastructure. We're building that infrastructure now. We might be early. We might be overbuilding, but we'll be the ready when the wave hits. Now, let me extract the lessons because there's something important here about capital allocation under uncertainty. First lesson. When you control the infrastructure layer, you profit from others' innovation. Huang doesn't have to know which applications are going to win. He doesn't have to pick the winners and losers at the application layer. He just has to ensure that whoever is building applications needs his chips. And if the adoption of AI is as universal as he believes, then everyone will need his chips. That's the game. That's the positioning. Second lesson. Demand signals are more important than timing signals. Huang said renting older generations of GPUs is becoming expensive. That's a demand signal. That's the market telling you something is valuable. When demand signals are strong, you build infrastructure. You don't wait for perfect certainty. You build ahead of the curve. Third lesson. Overbuilding infrastructure in a cycle of universal adoption compounds better than building just enough for current demand. If Huang is right that AI adoption is going to be universal, then every chip NVIDIA makes today will be deployed somewhere. Every data center built today will have computational demand tomorrow. The opportunity cost of building too much is lower than the opportunity cost of building too little. When adoption is universal, more is better than less. Here's what I find fascinating about this moment. The doubt is creeping in. People are questioning whether the AI spending is justified. Real investors are starting to ask hard questions about whether we're overinvesting. And Jensen Huang, the man with the most obvious conflict of interest, is the one saying no. The investments are justified. More investment is needed. Could he be biased? Absolutely. Could his incentives be distorted? Obviously. But is he also describing something real that he understands better than almost anyone else? I think so, because what he's describing, infrastructure becoming critical as adoption spreads, is something that's played out repeatedly in technology history. Electrification, railroads, telecommunications, the internet. Every major technological shift has required infrastructure to be built ahead of demand, and the companies that control that infrastructure captured disproportionate value. NVIDIA is positioning itself as the infrastructure layer. That positioning is only valuable if adoption is universal. It's only valuable if every company, in every sector, eventually needs chips and computational capacity. If Huang is right about that, then the current level of investment is not excessive. It's exactly calibrated to the opportunity. And the RealReal's Athena is proof of concept. It's a single application that required infrastructure to be built. But it's not the only application. It's one of thousands that are emerging right now. And each of them is going to drive demand for infrastructure. Each of them is going to drive demand for NVIDIA's chips. So here's what I'll leave you with. Jensen Huang is not saying more investment is needed because he wants to sell more chips, though he does. He's saying more investment is needed because the adoption wave is going to be bigger than anyone currently believes. He's saying we're still in the phase where applications are being invented. The infrastructure will need to expand to support those applications, and whoever controls the infrastructure layer will be positioned to capture value across all of them. That's the real thesis. That's the real bet. And that's why his comments about the AI bubble are worth taking seriously. Not because Jensen Huang is unbiased. He's massively biased, but because his bias aligns with a structural truth. Infrastructure layers, when they're critical, become more valuable, not less valuable. As adoption spreads, the RealReal's Athena is just the beginning. Moving to the last title, Thinking Machines Drama. Mira Murati raised $2 billion at a $12 billion valuation to start Thinking Machines Lab. That's one of the largest seed rounds in Silicon Valley history. She took 20 of OpenAI's best people with her, engineers from the post-training team, the people who built ChatGPT, people who knew how to teach AI models to communicate with humans. She had a founder story. She had talent. She had capital. She had everything you need to build something significant. Within a year, 3 of her 6 co-founders are walking back through the doors of OpenAI. The company she just left, the company she just competed with, they're gone. And less than an hour after they're fired, OpenAI's CEO for applications posts that they're back. That's the sound of a startup collapsing. Not gradually, not slowly, all at once. This story is about what happens when you build a company on a foundation of talent and founders, but you don't build anything else underneath. It's about what happens when the incentive structure makes it rational for your best people to leave, and it's about how even the smartest people in the world can make catastrophic capital allocation decisions. Here's the situation. Mira Murati was the CTO of OpenAI. She earned a reputation for emotional intelligence and lack of ego. She helped launch ChatGPT. She ran almost every aspect of the company. When Sam Altman was briefly deposed, she was named interim CEO. She was the inside person, the trusted lieutenant, the person who knew where everything was. In February, she decided to start her own company. She took 20 former OpenAI employees with her. That's a massive vote of confidence. These aren't random people. These are the architects, the people who understand the technical vision, the people who have relationships with each other. She put together what looked like a complete technical founding team, and then she raised $2 billion at a $12 billion valuation. That's extraordinary. That tells you something important. The market, the investors, believed in her. They believed in the team. They believed this company could be worth $12 billion as a seed stage investment. That's the level of confidence that gets extended to founders with proven track records and assembled talent. Now let's think about what happened. In the summer, Marathi began to suspect that one of her co-founders, Barrett Zoff, was having a relationship with a female colleague. Not just any relationship. A relationship with someone he had lobbied to bring over from OpenAI. Someone who didn't report to him. Someone who was junior to him. Someone who had also worked at OpenAI. This matters because of what happens next. Marathi confronted Zoff about the undisclosed relationship. He initially denied it. Then, by June, both Zoff and the woman told Marathi about the relationship, which had actually begun when they were colleagues at OpenAI. Here's where the situation gets interesting. Zoff told his boss that he had been manipulated by the woman into a relationship. That's his framing of it. He was manipulated. That's a significant claim. It shifts the narrative from a workplace relationship to something more troubling. Marathi put him in a new role, a technical contributor role. Reduced executive and managerial responsibilities. But something changed. Over the next several months, executives at Thinking Machines witnessed a drop-off in Zoff's job performance. His Slack usage, the main arena where the company did its work, declined precipitously. That's a signal. That's a sign that something fundamental has shifted. When your CTO stops showing up on Slack, when the person responsible for technical decisions becomes unavailable, that's a company in trouble. Zoff's response is that he was working as an individual contributor for 2 months. He was recruiting. He was doing roadmap planning. He was releasing the company's model training product. He was also out of the office in November and December because of illness and a death in the family. That's his story. That's his narrative. But there's another narrative running parallel. In October, shortly after another co-founder, Andrew Tulloch, left for Meta, Zoff reached out to Sam Altman at OpenAI to talk about coming back. Let me be clear about what's happening here. Marathi has a $2 billion company. She has just raised one of the largest seed rounds in history. She's competing directly with OpenAI, and her CTO is calling Sam Altman to talk about rejoining the company she left. That's not a casual conversation. That's a signal. That's a man who's either unhappy with the direction, or opportunity, or both. Zoff is testing the waters. He's exploring options. He's keeping the door open at OpenAI while still employed at Thinking Machines. By the time of their meeting with Marathi, Zoff, co-founder Luke Metz, and another senior employee, Sam Schoenholtz, had been holding talks with both OpenAI and Meta about joining either company. 3 of the most senior technical people at a $12 billion startup are in active negotiations with competitors. In the meeting with Marathi, they made a proposal. Give Zoff final say over technical decisions. Have one of the company's most senior executives report to him instead of Marathi. That's a demand. That's a power grab. That's not a negotiation. That's an attempt to restructure the entire company around Zoff's position. Marathi expressed unhappiness with Zoff's productivity. She asked whether they had already committed to jobs elsewhere. Metz and Schoenholtz said they hadn't. Zoff didn't answer. Let me parse that. Marathi asks a direct question. Zoff refuses to answer. He doesn't say yes, he doesn't say no. He just doesn't answer. That tells you everything. He's already got a deal lined up somewhere else. He's just negotiating the severance. On Wednesday, he was fired. Marathi posted on X that Thinking Machines had parted ways with Zoff. Less than an hour later, OpenAI's CEO for applications, Fidji Simo, posted that Zoff, Metz, and Schoenholtz were returning to OpenAI. Now let me think about what this reveals. 3 of the company's most senior people, people who were recruited from OpenAI, people who had access to Marathi's strategy, her vision, her capital structure. They waited until she had raised $2 billion. They waited until the company was in a position of strength. Then they left. They went back. The company now has 3 of its original 6 founders. That's a 50% turnover at the founder level. That's not a setback. That's a catastrophic blow. Let me think about the capital allocation question here. Murati raised $2 billion. That's $12 billion in valuation. She took 20 employees from OpenAI. She built a complete team. She had a vision. She had execution capability. What went wrong? On the surface, it looks like a people problem. Zof had relationship issues. His performance declined. He was unhappy with his reduced authority. He found a better opportunity at OpenAI. But that's not the real problem. The real problem is that Murati built a company where the entire value was dependent on specific people. She built on founder capital and talent. She built on the assumption that these 20 people would stay together. She didn't build systems. She didn't build culture. She didn't build anything that would keep people there if the environment changed or if better opportunities emerged. This is the classic founder trap. You assemble incredible talent, you have a big vision, you raise a lot of money, you assume that's enough. But talent is volatile. Incentives matter. Opportunity cost matters. If you're Barrett Zoff, here's your situation. You were a co-founder at Thinking Machines. You have reduced authority. Your relationship issues are being discussed internally. Your performance is being questioned. Your boss is unhappy with you. On the other hand, Sam Altman is offering you a position at OpenAI. OpenAI is worth hundreds of billions of dollars. It's the dominant company in AI. It's the company that everyone is competing with. And you built ChatGPT. You know the system inside and out. You know where the opportunities are. You know where the gaps are. What's the rational decision? You go to OpenAI. You take Luke Metz and Sam Schoenholtz with you. You have leverage as a group. You have technical knowledge. You have relationships. You're valuable. The question is, why did Murati create a situation where the rational decision was for her best people to leave? She could have kept Zoff in a position of power. She could have valued him regardless of his personal relationship situation. She could have created incentives for him to stay. She could have made it clear that the future was at Thinking Machines, not OpenAI. Instead, she reduced his authority. She signaled that she had lost trust in him. She created an environment where the best option for him was to leave. Now, here's the capital allocation piece. Murati raised $2 billion. That capital is now financing a company with 3 of its 6 founders still there. That capital is now financing a team that's weaker than it was 6 months ago. That capital is now competing against OpenAI with a team that's been depleted of some of its best people. What was expected? A startup that could compete with OpenAI, a team that could build a superior AI model, a company that could capture value in the post-training space. What actually happened? 3 co-founders left. The team was depleted. The company was weakened. The competitive position was damaged. The opportunity cost is enormous. $2 billion could have been deployed elsewhere. It could have been invested in a company that wasn't going to be hollowed out by defections. It could have been invested in a team that had stronger retention dynamics. Instead, it was spent on a company that lost 50% of its founder team within a year. Let me extract the lessons because there's something important here about how startups fail. First lesson: talent is not a strategy. You can have the best people in the world, but if they're not incentivized to stay, they'll leave. Murati had the talent. She had the vision. She had the capital, but she didn't have retention dynamics. She didn't have equity structures that locked people in. She didn't have a culture that made people want to stay. When the environment got difficult, when Zoff's authority was reduced, when the relationship issues emerged, he had an exit. And he took it. Second lesson: founder dependency is a liability, not an asset. You want your company to be dependent on systems and strategy and culture, not on specific people. Murati built a company where the value was entirely dependent on keeping Zoff, Metz, and Schoenholtz happy and productive. When they got unhappy, the company fell apart. A more robust company would have had deeper benches. It would have had succession planning. It would have had redundancy. Third lesson: reduced authority is a signal. When you demote someone from executive responsibility, you're sending a message. You're saying this person is no longer trusted with strategic decisions. That's a signal that it's time to leave. Zoff understood that signal. He called Sam Altman. He explored options. He found something better. Here's what I find important about this case. It's not unique. This is what happens repeatedly with venture-backed startups. You assemble incredible talent. You raise a lot of money. You assume that's enough. But the incentive structure of the startup world, the openness of the talent market, the ability of smart people to find better opportunities, all of that works against you. The best way to hold on to talent is not to reduce their authority. It's to increase their authority. It's to give them equity that vests over time. It's to create alignment between their interests and the company's interests. It's to be clear that their future is at your company, not at a competitor. Marathi didn't do any of that. She chose to question Zoff's judgment. She chose to reduce his authority. She created an environment where leaving was rational. And now she has a company with $2 billion in funding and 3 of its 6 founders. She has a company that's competing against OpenAI without some of the people who built OpenAI. She has a company that's weaker than it was a year ago. Here's what I'll leave you with. The AI race is being described as a battle for technology. It's not. It's a battle for talent. Whoever can keep the best people, whoever can create an environment where they want to stay, whoever can align their incentives with the company's interests, that's who's going to win. Marathi had that talent. She let it walk out the door. That's not a startup problem. That's a capital allocation problem. This is Avi. Like and subscribe. On to the next.